how to find comparable multiples. So, just to quickly give you a little bit of background to all of you, basically there are three approaches for valuation of any company anywhere in the world. Please remember, पूरी दुनिया में जो वैल्यूएशन की अप्रोचेज हैं और जो वैल्यूएशन के मेथड हैं वो सब सेम है, वो सब सेम है. सो व्हाट आर द अप्रोचेज? द फर्स्ट अप्रोच इज इनकम अप्रोच. एंड इनकम अप्रोच का मतलब क्या है? इनकम अप्रोच का मतलब ये है दैट व्हेन यू आर डूइंग वैल्यूएशन ऑफ अ कंपनी using income as the base or using information about income as the base, that is known as income approach. So your discounted cash flow method is what falls into the category of income approach. Sometimes it may not be possible, uh, or in because of different reasons, company can also do the valuation using the market approach. What is market approach? Market approach का मतलब ये है कि when you are using market information for the purpose of valuation of a company, it is known as market approach. And number three is the cost or the asset approach. और cost और asset approach का मतलब क्या है? Cost और asset approach का मतलब ये है कि when you are trying to do the valuation of a company or of a business based on the information about the cost of the assets, that is what is known as cost approach or the asset approach. So this is the simple understanding I thought I would share with you, so that you have a clear background as to which are the approaches, number one, and why those approaches are called by those names, and that is number two. So ideally, what you should do in case of a listed company, you should use the quoted price. You should use the quoted price, and that is how the SEBI regulations under this SEBI regulation about CEST talks about the quoted price. But that quoted price is only in case of a frequently traded shares. For the infrequently traded shares, the SEBI regulations talks about market multiples. So what is the multiples? So multiple का मतलब ये है कि you try to find value of your company by comparing your company with another company. So let's say, for example, you are trying to find value of a company X, and the shares of company X are not frequently traded, they are infrequently traded. So since they are not frequently traded, the quoted price of X cannot be used for the purpose of pricing the offer price in this case. So what you do, you find out a comparable company which is listed on the stock exchange and which is frequently traded. And let's say you find a company called Y which is listed on the exchange and whose shares are frequently traded, and this company is more or less like company X. So you find out the value of this company, and let's say you find out the value of this company to be 1000, and divide the value this value by the earnings. Earnings. So and let's say the value of the company is 1000 and the earnings are 100. That means there's a PE multiple, and this PE multiple is 10. So 1000 divided by 10, this is the price and this is the earning. So price divided by earning will give you PE ratio, which is also known as PE multiple. So what you will do, you will use the PE ratio as a multiple. So what you will do, you will find out what is the earning of company X, and you realize that company X's earning is 200, right? And then what you do, you multiply the PE ratio, which is 10, with the earning of this company, which is 200, and you get the outcome, which is 2000, and that means the value of company X is 2000. And this Pooja is your comparable company method, or multiple, using the comparable multiple method for the purpose of valuation. I hope this answers your query, Pooja.
Yes, sir.
Okay, very good, very good.